Good morning, good afternoon, good evening, wherever you are. This is Dr. Nelson Ogunshake from FIDIC in Geneva. I'm delighted to welcome you to the first in the series of State of War report delivered by FIDIC. Today, I'm told we have in excess of 700 people register all over the world to participate in the official launch of the book that we are actually producing today. We've got an exciting panel who contributed to the report, and in time I'll be introducing them to us in a minute. Today we're making a big difference in the sense that traditionally we cover basically the COVID webinar. We are looking back into what we've done last year. Next slide, please, Barbara. We're looking back into what we've done last year, and we're looking back and said the journey so far. Last year, for some of you, you've been following FIDIC. We staged 18 webinar on COVID. We had 15,000 people that registered for that. And out of that, 9,000, actually attended the program from 150 countries, close to 80, speakers all over the world, leaders who joined and participated. Since then, we've had close to 10,000 people on YouTube who will subsequently follow the program. This year, we're slightly, doing 3-in-1. Next slide, please. And the 3-in-1 is we will continue with the COVID because we thought by now we should be looking at coming out of our COVID or post-COVID, but we are still there. Vaccination is not completed, it's progressing, but we are still dealing with the COVID and we continue to deal with that for the rest of this year. At the same time, we're looking internally and looking at what our members are doing in terms of our committee. We've been running a series of committee, webinar, which look at issues about risk management, diversity and inclusion. So far, so good. This year, we're adding on the State of the World, which is not new, but actually in a repackage in a different format. And you will hear Bill talking about it later on in the format structure. The purpose of the State of the World is to pick a topical issue that impacts our industry, that cuts across, and effectively give us an opportunity to do a deep dive. And we will be releasing a series of reports over the year. We're aiming for 3 or 4. And today, we're really looking about the issue of investment in infrastructure. And as Bill keep reminding me, and he's quite right to do so, that there is 2 parts to looking at this subject. One is about getting the financial engineering to do the investment in infrastructure, but more important is about making sure that our industry deliver value for money and effectively make sure that we can reduce the whole life cost. So today we're looking at the front part of it, which is what is the issue, what are the challenges, and how do we move forward. So on that note, I'm going to invite Bill Howard, FIDIC president, who's been joining us for the last webinar to do a welcome reception and actually give us an opening speech. So Bill, the floor is yours. Thank you.
Thank you, Nelson. I'll try to be brief. I'd also like to thank you personally, Nelson, for all the webinars and town halls that you've been putting on over the time of the pandemic. It's allowed FIDIC to communicate and connect with thousands and thousands of people around the world, and I think that's fantastic. We couldn't do it without a great secretariat and under your leadership, so thank you very much for that. I would also like to thank the 6 speakers that we have today that are quite diverse from multilateral development banks, the United Nations, a couple of our firms, as well as representing Sustainable Development Committee, and the Future Leaders Group. And I mention those 2 because those are the 2 groups that FIDIC is depending on to drive this State of the World initiative forward. We've been doing State of the World reports for a little more than 10, 15 years. And I'm very excited that they're being re-energized and conducted more in a more modern way of communicating. And we are excited that the Sustainable Development Committee and the Future Leaders Committee are the 2 groups that will be leading the charge, because everything we do needs to be sustainable. It's an avenue to reducing the actual cost of required investment. And of course, the future leaders represent the group that will inherit a lot of the challenges that we face. As Nelson mentioned, today we're going to be talking primarily about the financial challenge, which is beyond huge. Absolutely a massive challenge that we need to talk about. Nelson mentioned value for money. That's always on the table. So today's focus again is going to be primarily on the finance. There are, as Nelson mentioned, future reports coming, and those reports will be looking at the technical business case for action, as well as strategies to reduce the financial costs. And both of those strategies, raising money as well as reducing costs are incredibly important if we're going to succeed. In terms of the business case, there are tons of them for action. As an environmental engineer, I often express the frustration that I believe a lot of us environmental engineers have, that there are still billions of people without access to sanitation and clean water, despite the fact we have the technology to provide it. We've got to solve this problem. And it's been going on for a long time, and it needs to be resolved. We will not be talking about that today. We will, however, be talking about those and many other challenges related to water resources in the not too distant future. And finally, I'd like to thank the participants for joining us today. We need your input, we need your questions, and we need to make sure that we're heading off in the right direction. So thanks again for everyone who's been working with us on the State of the World initiative, and we're looking forward to re-energizing it. Back to you, Nelson.
Thank you very much, Bill, for that welcome opening statement. Just to set the scene, what we're looking at, as Bill said, is we are looking at a series of State of the World report. They will be manageable and chunk. Today, we're looking at investment, time to invest. That's the real world is coming through. And I'm delighted that we've got a very, very high caliber contributor to that. I will start as shown on the photograph. First of all, Sir Danny Alexander, Vice President of Asian Infrastructure Investment Bank, a very close friend of ours who's done a fantastic job in UK, doing exactly the same in Asia. And we've met recently, and he continued to support us. We've got Rowan really from United Nations supporting us, also contributed to the report. And I think, I understand they are also producing a report, in a couple of weeks' time. So it'll be interesting to see, how these two reports are connected together. You got Mark Warrow from AIX, which is looking at exchange. How do we look at, our asset base and maximize the way we use our asset base into our value and recycle that? Also, we've also got Nadia, which is really coming from Australia, and she's looking at it from the point of Sustainability Development Group. And I think it would be quite good to actually get her feedback and comment, and she's contributed to the report. So Natalie, your contribution, I'm looking forward to that. Adam, you chair our Future Leaders Group, based in Poland. You've been absolutely boisterous in the issue. And as Bill said, we want to see the future leader being involved. Again, Robert works for AECOM, based in UK, head of sustainability. So he's also contributed. And actually, the panelists are actually quite exciting. They have contributed extensively to the report. Just to put things into context, I'm informed right now as we've gone live that the report is now available to be downloaded on our website, and we'll be tweeting about it during the day. And of course, there's going to be a lot of questions that will come from this discussion. We are not, planning to just give a report and give it out. One thing Bill said we need to do, we've got to be engaging with the conversation. We have to be at the table. We have to have thought-provoking and thought leadership subject for discussion. And I'm really pleased that Bill is able to join us. We've got this high caliber to help us on set scene in motion. So you will hear from individual of them. The report actually set out in details the challenges, and also look at issues that we need to address. And as Bill correctly said, we'll be going forward to look at how we unpack that in terms of how the engineering profession and the industry can help to reduce the overall cost of the asset. So at this point in time, the approach we want to take is very simple. Let me set the scene. First of all, is we're going to have a brief outline of the report, which Graham and I will deliver. Graham is our head of economic and policy within FIDIC. And then once we've done that 5-6 minute presentation, which look at the headline, I'm going to put questions to the panelists because they've contributed, they have seen the report, they know the report, and the question that I'll be putting across to them is very much specific to their section. What I intend to do is to cover all the panelists as quickly as you can. I do understand that Sir Danny Alexander needs to leave in about 45 minutes, so we try and do the best to cover as much as we can before he leaves. But come 12:45 Central European time, he will step out, and we thank him for giving us the time in supporting us. But we should cover most of the question. Thereafter, we're going to open the question to the floor. If there is a particular question that you wish to put to Sir Danny before he stepped down, then please, let us have that chat and we pick that up. So at this point in time, we're going to go on to the next point, which is really, next slide, if I can get it, Barbara. And what we also want to do as we go through this process, we want to engage the participant in few questions. So the first question that is coming across, I hope you have the opportunity to actually vote, which is how much do you think the infrastructure investment challenge is going to cost in a year going forward in the future? Can you please make an attempt and put a point in there and submit? We'll get the feedback. This is really to give us a kickstart into the conversation so we have an understanding of the perception of the participant. So time to vote. Please, vote and press submit and we get your feedback within a second. We can move on into the conversation later. Barbara, how are we doing? Right. Majority of people are saying 5 trillion per year. That's 39%. And quite a lot are actually saying 18%, 6 trillion. And there is a small percentage of 15 to 7 trillion. That's a real challenge. That's a real challenge for us. So we're going to move on to the next point. That's a good start point. The second poll that is going to come through is actually looking through how we will be spending more on maintenance than investment by 2050. This is the question. Are we going to spend more on maintenance than in the front-end investment? Answer yes or no and vote, or don't know. Do we think we're going to be spending more on maintenance than in the front-end investment? This is looking through the asset base and actually saying what is the state of the asset base, and we're going to spend more on future than actually in the greenfield asset base. So vote. And the feedback, Barbara, can you share that with us? Thank you. 68% are saying, yes, we're going to spend more on maintenance. Now, that's a vindication that perhaps in the design solution that we've been putting across and in the allocation of the fund, that we are not taking a holistic view of the way our asset is, whether in the sustainability, in the whole life cost. That's a challenge for our industry. So let's move on into the real session for this. So at this point in time, I'm just going to try and set the scene. My understanding of the report is actually covers 6 areas, which Graham is going to be invited to give us a very quick headline. And for those who haven't seen the report is available or be downloaded. The first point that I think Graham is going to address is, why are we facing a significant challenge in the infrastructure sector? This is looking at it before COVID, SDG, and now COVID. The other one is consideration when industry is complex. How do we address the challenge in the in complex industry that we live in? The third one, which I believe is going to be a topical one for us, is the elephant in the room. What is the impact of COVID? We talk about phase 1, we talk about phase 2. What is the consequential impact, especially when people start looking about the phase 1 dealing with the public health, and the phase 2, we're now looking into economy and issue. And then the other one is, was there any unexpected benefit that we need to look at in the way we structure? And I believe that is a big challenge for us to look at. And then the other one, which I think on the basis of SDG, is that are we, being sustainable in our approach? And I'm sure Sir Danny and also, our friend from United Nations will be able to give us their view. This report provides 3 recommendations, and those recommendations are something that we want to work on going forward. So Graham, at this point, I'm going to ask you to take the floor for 5 minutes and just outline the main selling point of the report, and then we dive into the Q&A. So Graham, the floor is yours. Thank you.
Thank you, Nelson. Yes, so I mean, as has been alluded to, the challenge we face is, to say the least, significant. There have been several reports over years that outline the global challenges. If you go back, and this is where the report starts, it's, if you look at current needs, you're talking about 3.2 trillion a year is what we're spending. We need to be spending nearer 3.7. If you then look at the SDGs, you're talking about the fact that we need to be spending somewhere between 5 and 7 trillion. So we're instantly up in the game already. And then if you take the current situation with COVID, they were talking about, before the second wave hit, a potential impact this year of between $1 and $2 trillion. And that was on the assumption, the doomsday, the $2 trillion assumption was based on the fact that the second wave either did not happen or was relatively minor. I think it's fair to say that the second wave has possibly been more challenging than the first. From the UK, I can tell you the numbers are at least 4 times that they were on the first wave. So the challenge that we face is put into the concept of this, and this is where this report steps forward, because it is not only taking the infrastructure challenge that's existed before, it is considering the fact that COVID has been there and does occur. And also, if you look at it on terms of the SDGs, we've lost nearly 12, 18 months. Go back 12, 18 months, we had a decade to solve these problems to hit goals in 2030. We now have less. And the sort of figures we're talking about, if you're doing that a year, means that we've already lost a lot of ground. So you're looking at effectively $7 trillion a year that need to be invested at the moment. We have to recognize within this that investment decisions are complex. You have economic circumstances, you have political circumstances, you have taxation and legal circumstances. This is not a simple problem to solve, but it is a problem that we will need to solve going forward. And COVID in some ways has made that more complex, because people's attitudes and the way in which people want to use infrastructure will change out of COVID. That may mean that the investment on commuting and items changes. It may mean that investment on things like healthcare and health systems may increase significantly. And that is the elephant in the room. COVID is that thing. We have seen in the last 18 months, massive support mechanisms put in place by governments to support effectively workers and jobs through COVID and sections of the economy that have been closed. These are significant investments, but they are in essence short term. They support now, they're not investing for tomorrow. What we're talking about in this report is that we need to start shifting towards the investment for tomorrow, because the debt that has been built up and the money that has been spent will turn around and make it harder tomorrow to invest for the day after. When we came out of the financial crisis 10 years ago, it was difficult because we had constrained finances. There is not a financial crisis this time, but the economic crisis out of COVID should not be underestimated. And it is important that the infrastructure community stands forward and that we make sure that the investment required for infrastructure occurs and we turn around and meet the challenges that we face going forward. I mean, there were some unexpected benefits of COVID, to put it in the nicest way possible. We have, for example, Venice, where rivers are clear and blue that you've never seen before. There are cities without smog in them. And interestingly, it has shown that maybe the way we operated prior to COVID may need to change, but there may be some ways we can adapt to make investment better, improves people's lives along the process. So that is the emphasis of the start of the report. We then go into the next interesting bit, which I know Bill and Nelson talk about, which is the maintenance side and investment versus maintenance and sustainability. Now, this is interesting because we took data from countries, and if you compare them and you take out all the outliers and various items that you can, it actually shows that the investment maintenance ratio is declining. Now, whilst you can have two sides of a ratio go up very differently, it does raise a fundamental question of, are we investing more sustainably? And it was interesting that the poll showed that most people think we will be spending more on maintenance than investment going forward. I mean, that to me is quite concerning, because you are operationally spending, you are not investing for the future. If we turn around and take the results of this report, the current ratio is around 3. It was around 3 in 1995. It's currently around 2.2. If you stretch out to the SDGs to 2030, it's about 1.7. If you stretch it out to 2050, we will be spending as much on maintenance as we do infrastructure. That is not investing for the future. That is not potentially acting holistically. So out of this report, there are effectively 3 recommendations. 1, we need to turn around and stand up and recognize the investment challenge and the fact that the last 18 months has put pressure on that challenge that no one was expecting. 2, that we need to monitor that investment maintenance ratio better, but we also need to understand it better, because we all talk about investing sustainably, but unfortunately the evidence doesn't seem to suggest that we are currently going in the correct direction. And 3, we suggest in the report a mechanism where we transfer effectively operational and current day-to-day spending from if you like, our carbon heavy industries towards investing in sustainable industries for the future. So we create a capital envelope across the globe via various countries where we ensure we hit the SDGs by 2030. And so I think, to be fair, given the trillions that are mentioned, that's enough of a challenge for this panel to deal with. And I will hand it back to Nelson.
Thank you very much, Graham, for that. A lot of highlights. I think the 3 point they raised was, yes, we need to invest in infrastructure. 2, we need to monitor. And 3, is there any way of making any saving from our current pattern? And at this point in time, perhaps, if you go to the next slide, we have eminent panel, still, which I want to call up. I have Sir Danny Alexander, I have Rowan Palmer from United Nations, I have Mark Warren, I have Natalie from Australia, I have Adam from Poland, and I've got Robert from UK. So a very eclectic, balanced team of people. Obviously, a lot is being said, and you've all contributed, and I want to thank you immensely on behalf of FIDIC board and on behalf of our members from 102 countries around the world, with over 5 million, people working in our profession as professional services. I'm really delighted, and Danny, we know from our work in UK before, we always use this sort of multiple of, 2.8 for every $1 you spend in one infrastructure investment. There's a multiplier of creating jobs that come into that. The challenge that we see is real. From what I hear, it is real challenge. The primary challenge, if I get it correct from what Graham is saying and from what all the panelists is saying, is that yes, we do have natural shortage in infrastructure investment. Then we have the target set by the Sustainability Development, United Nations on the SDG. And then we now have the impact of COVID. And somehow, what I'm keep being told by Bill, and he's saying it loud and clear, we need to sort out the financial engineering, but we also need to sort out the engineering of the solution in such a way that we can reduce the overall cost. And that way we get true value for money. So at this point in time, our approach is going to be very simple. I'm going to start with Sir Danny because he needs leave. The question I'm going to put to you, and thank you very much, if I may say that, Sir Danny, for your contribution, is that the challenge that this report is out is significant. And as AIB is one of the new kids on the block, what do you think could be done to meet the challenges we are presented with? Danny, the floor is yours.
Thank you very much, Nelson. And may I start by congratulating you and your team on this report and on this webinar and the series of webinars that you've been running during this time, helping to keep people together and discuss the most important challenges. And I think you're highlighting the right things. And COVID has an impact not only on our immediate circumstances, but also on how we think about the future. So last year, at the end of last year, AIB, which has just reached its 5th anniversary as a new multilateral development bank, we published our first corporate strategy, which focused on investing in infrastructure for tomorrow, trying to identify what are the infrastructure needs that our members, and especially developing countries where the multiplier that you refer to is even higher, will need for the future. And obviously, COVID has highlighted that in many societies, healthcare infrastructure is the weakest link in the economic chain as well as in the social chain as well. But I think also it highlights the importance of trying to think ahead and plan ahead for crises. And with climate change, we know there is a massive issue coming down the track, and we have to start ensuring that we're investing really much more comprehensively in the sustainability of our infrastructure, environmental sustainability, climate sustainability, but also, of course, financial and economic sustainability and social sustainability too. And so in our corporate strategy, we also commit to increasing our investment in climate-related infrastructure to 50% of our financing by 2025, which is one of the most ambitious goals among the multilateral development banks. But I think, one other area I would highlight, given the time constraints, is about technology and digital infrastructure. And again, we see, as we look at many places around the world, that the quality of digital infrastructure has been one significant factor in ability to manage and respond to this crisis. And certainly here in Asia, we see digital divides between the digital haves and have-nots. And we see, as AIB, a major role in investing in digital infrastructure to try and bridge some of those digital divides. I think healthcare, digital healthcare is going to be a major investment area. And that goes alongside connectivity and also private sector capital mobilization, because, though in AIB's case, as an international financial institution, we have $100 billion of capital at our disposal. The multi-trillion-dollar needs that you're highlighting mean that in order to be effective, we have to use those resources in a way that mobilizes much greater private sector investment in infrastructure than we've seen so far. So I think if we can focus on those issues, then we will truly be able to build back better, to quote the slogan that's often rightly being highlighted now.
Thank you very much, Danny. The next question I was going to put to you, because I'm conscious of your time, is that in your report you emphasize the need to have a shift in investment from actually looking at it from the point of view from focus on monitoring and maintaining. Can you provide experience of expertise given the work that is being done by AIB for this ambitious plan, which is how do we monitor the ongoing investment in maintenance?
I think this is another area where technology can play a huge role. So for AIB, in common with other multilateral development banks, we also apply very high standards to our projects. And so it's not just providing the financing, it's making sure that the environmental and social commitments that have been entered into are met. It's monitoring the procurement. It's ensuring that anti-corruption policies are enforced and so forth. And that can be done by people on the ground. But actually, increasingly, we see that not only digital infrastructure, but also applying digital technology to more traditional infrastructure is crucially important to ensuring that infrastructure is well maintained, to monitoring the progress of projects, and indeed to also the approval process and financing process for projects. And so I think, in other areas of financial services in the last decade or so, particularly retail financial services, we've seen digital transformation, which has changed the way that people access finance and the way that people do their work. I think that we can expect in the next decade to see that wave of transformation coming across sectors that have not been so affected, private assets, project finance, project monitoring. And as a new institution for AIB, we have an opportunity to make the most of that emerging new technology, to maintain our high standards, to maintain the strong governance that we have, but to perhaps access projects that were not available to MDBs before. And so I think that's an incredibly exciting opportunity where for all of us, we have to think about how we can apply technology to do our work in a different way, do our work more efficiently, enhance those multipliers that you were referring to earlier even more greatly, and so make the most of the investment we're making. Incidentally, if we can use technology to monitor the safety and quality of assets over time, then one suspects that those assets will last longer, and so maybe the answers that people were giving to the balance between investment and maintenance have a rationale in that area too.
Thank you very much, sir. I will come back to you, Danny, later on, but I just give you some time to reflect on that. You touch on a number of points, which actually is very much in sync with what Bill has been talking about, where it's saying we now use technology that's drone to look at survey, to plan our process, to do maintenance of assets. There is the 3D that goes through, there's the BIM system that come into play. Surely all of this should help us to find that the way we maintain our assets, we keep it in good shape, and we can actually make sure that we can replenish them where we need to replenish them, so that we don't spend too much money on a major refurbishment by taking a gradual process. So the monitoring point you raised is absolutely, absolutely critical. And I'm glad that AIB sort of signed up to FIDIC contract like any other MDB, and looking at the issue about transparency, integrity, all of those things are very much aligned the line issue about monitoring. So it's very good, because compliance for most of the MDB is absolutely important to make sure that you deliver the asset, not just the front end, but actually the whole life process so that you can deliver the value that you expected from that. So thanks, Danny. I'll come back to you in a minute. Mark, I will really bring you back into Mark. Mark Worrell, your business is about estate management, and it's really about finance and refinancing. The question I was going to put across to you: how has COVID affected the liquidity? Can you give us your expert view, Mark, into what is the impact of the COVID on liquidity in the market? What is the challenges that goes with that? Mark Worrell, where are you?
Thank you, Nelson, and thank you everybody at FIDIC for setting this up. If I may, just for a second, I'll just say 2 words about what we do. So we're a brand new exchange based in the City of London that effectively finances only infrastructure projects. So our journey is fundamentally to turn infrastructure from being an investable asset class into being a tradable one. So your question on liquidity is a good one. I think obviously 2020 brought a lot of things to a standstill. I think what has happened with liquidity, and I'm going to answer the question in a slightly roundabout way, is that what has happened is what in March last year, in particular in Europe, what occurred was when the lockdowns happened, we ended up with a position where people found themselves holding asset managers, pension funds, sovereigns ended up finding illiquid assets on their books, and we saw gated funds, we saw paralysis, if you like, in terms of people, especially retail investors, being able to take their money out of the system. But I think what's happened as a consequence of that, and there have been various reports coming out from the pension funds recently, is that traditionally they've always looked at risk and return as their main measure over whatever time frame they're invested in. But now what they're looking at actually is on a pari passu basis is actually leveling up liquidity provisioning as part of that. So the ability to come in and out of an asset becomes more important. And I think this becomes critical if you're going to attract as a sector private capital to sit alongside the MDBs and other parties that are at the front line of taking the risk. And it all comes down to risk pricing. So on the exchange, what we're able to do on a transparent basis is run competition, if you like, for pricing, which enables people to, if they like the particular paper, to do 2 things. One is to take a small proportion and syndicate that money across a number of assets. So if you're trying to buy into a waste to energy site and it's, I don't know, 200 million, you might only want to invest 20 million rather than try and invest 200 million. And obviously that's much better because you can build the portfolio according to the risk profile over time that you wish to hold. That will make it much easier for private capital to sit with you. So that's one aspect of liquidity. The other aspect of liquidity is to ensure that obviously you're able to come out of it if you've already realized a part of the risk curve that you want to make your return on. So if we take, for example, construction risk, which is a big problem in the main for getting capital into the sector, then actually if you've got a small proportion of your money in, but there's a secondary market where there's a 2-way price for you to come out of, then actually that is something that could be sustained. So on the exchange, for example, next year, we'll also bring to bear parts of the capital markets, which I think is very, very important and has been missing as a tool in the toolbox from the asset class. And that is to try and bring in derivatives, options and credit derivatives, to start to move and play around with that. And that will enable projects to move the risk. So if you're sitting in an African country or sitting in a Latin American country or anyone in an emerging country, then that enables you to do that. And we actually address projects right around the world. We're London based, but we do projects around the world. So I think, you know, if you can bring those things, you start to address the flow of capital from the private sector, and then that's the liquidity that you're looking for. So if you like, the people with the money don't have the expertise, and the people with the expertise don't have the money, given this is an engineering forum. I think it's terribly important to address that. And if you like, the exchange as a benchmark, as a toolbox, it helps to make that happen. So I think, to answer your question, liquidity has been tight, but I think using these tools, you can start to unlock the liquidity for the coming year. And I think it's imperative, given the size of the problem, that you start to look at competition for price, competition for tenor, competition for LTV, and at the end, and in the end, obviously, competition for being able to revolve capital.
But Mark, you know, if I didn't understand what you've said, then it means that I have problem. But I can see Sir Danny shaking his head most of the time, all the points you raised, he can relate to that. Because one of the points that Danny said earlier on, if I can remember, he said, we are trying to be the most sophisticated, MDB, and we want to work with the private sector. And it seems to me that if we want to work with the private sector, You need to create a market where you provide opportunity for people to come in and go in a very sustainable manner, and also depending on their risk and their appetite on their portfolio that they want to be pension fund or not, they need to look at how the size you raised one particular area. There's a perception about construction risk, i.e. escalation of costs, delay, disruption, and all of that issue. And that give concern to pension fund or give concern to other investors who said, I'm not going to put my money in there. So the question I was going to put across to you, how do we make infrastructure more interesting and more attractive as an asset class for investors? How do we make it attractive and interesting as an asset class? Danny wants to invest. There's huge amount of money, but he doesn't want to put all his money in one basket. So there will be other people also want to come to the equation. They don't want to put all their money in one basket. So how does your exchange work out and make the infrastructure attractive? Is it structuring it? Is it packaging it? Is it the way you do the financial engineering side of it?
So
all of the above.
Yeah, thanks, Nelson. From a data, picking up on one of the commentary that Danny was making about digital solutions, I think from my background is data in particular. So let me come back to data. I think if you're going to make this more attractive to funds, there needs to be more education, and that education of projects and project risk. So at the moment, I don't think enough education happens from the engineering side about what those risks are. So I'll give you a sort of a small example, which is, Thames Tideway. So the people that invested from financial institutions in the UK in the Big Sur in London effectively thought that the risk was in the tunneling, but the engineers knew it was in the report, the land report that came before. Now, it's a simple example, but it's critical to understand where the risk sits if you're going to price it correctly. And at the moment, what is needed, and we're building this as part of the exchange, we have a data business, is it's important to be able to get project data in order to get the data, to get the information, to then have the applications to actually turn something into intelligence, which then allows you to lead to hopefully some perceived wisdom of the decision you're making. And that process of actually getting project data into the domain where it can be analyzed so people can understand what they're comparing one to the other is a really important one. So later on this year, we'll be launching the business, which will enable people to be paid royalties for the usage of that data from their projects. So if you like, data in infrastructure, regardless of what type of engineering firm you are, will suddenly become an asset you can earn money from. And we think that if we can start to do that, you can start to share information, which you can then benchmark or cut and slice it as you wish. Okay, that's the point. In terms of attracting the money, the fundamental problem at the moment is most of the deals that we see done from the private sector are done through private placements. And the issue with private placements is they are led by investment bankers. And the problem with investment banking is it's set up to do one particular thing, which is a deal quickly to their advantage. So they want as fewer people in the deal and close it as fast as possible. And that leads to a coalescence around deals that typically are already built and provide a return, which means that you've got this massive gap that Graham was talking about from the report. So the question then is how do you address that? And of course, on the exchange, I would say this, on the exchange, obviously what you're participating is you're allowing syndication to occur. We don't care if there's 100 people in a deal, as long as you're taking a little bit of risk and that you actually make it more available to people. And that hopefully provides a catalyst to the marketplace to try benchmarking exactly what is going on in order to enable more flow, which is critical to financial markets, in order to then to start to meet the requirement that you have in the general market. And it doesn't mean that everything needs to go through the exchange. Again, I'm not saying that at all. What I'm saying is it will provide pricing mechanisms that you can benchmark from and provide confidence to the private capital.
Thanks very much, Mark, for that. It's a very detailed analysis. I think what I'm getting from you, because a lot of people there was a time, and I think I refer back to Daniel on this, when he said the government was putting so much money, like bank guarantee, 40 billion, I think it was in those days. And then the message was, how do we get private sector to come into? We try to attract the pension fund. And pension fund, well, I'm not going to take the risk because there's a construction risk. We don't understand the construction risk. And the question is, if they have that money, they can split it, but they need data to enable them to make an informed decision. And I think the point you make is actually quite interesting. But I'll go back to what the FIDIC president is saying, is that we have the technology, we can have embedded technology in engineering solution that enable us to monitor, And then you can look at the performance of the asset, and that help in judgment as to where you want to invest on it. So thank you very much, Mark. I'm going to come back to that. I know Sir Danny needs to leave in about 10 minutes, so I'm going to put one question to him. But before I do that, we have one of our young professional leader called Adam, who is here. And now Adam, the question and the figure we're talking about is mind-blowing. How does that fit with you? You are the future leaders. How does this fit in the challenge that we have to deal with in our industry? I mean, I see this as an opportunity, but you guys are young, dynamic, you're thinking outside the box. How do you deal with this challenge? Adam, where are you?
Thank you, Nelson. I'm very mindful of the time, so thank you, Bill, Graham, and FIDIC for letting us provide our future leader perspective on this. I think there is two perspectives. There's the human perspective, and with the high pressures that Bill mentioned initially, I think an anecdote of this is, as you can see, your future leader chair has gone bald and his beard is getting gray. So resiliency, I think, will be the key when it comes to human perspective. But more seriously, the business career perspective, I think, is enormous for us as future leaders. Whenever the report outlines the scope, the budget, and the timeline of things that need to be done, and we as consulting engineers, once we have a scope, budget, and timeline, I think that's an opportunity. We need to focus on our careers, on what's required, such as data miners, decision system sciences. Engineers are acting more and more outside of the box, not just traditional designers, but helping the client define the scopes. Work on sustainability and intelligent projects cannot be done without data mining. BIM, I think there's plenty of areas for us to contribute to and intelligently align our careers to be able to contribute to executing this report resiliently. So thank you.
Thank you very much, Adam. I think what I hear from you is a real opportunity. I'm mindful, so I'm going to go back to Sir Danny now. The question I was going to put across to you is really that given that the COVID crisis and loss of 2 potential years of progress, what can be done to regain the vital momentum to meet the 2025 target that you set? Quite clearly, 50% of AIIB needs to be approved in financing direct. How do we bridge the gap, having lost 18 months to 2 years in the plan? Because if AIIB is having the same challenge, the World Bank will have the same challenge. The EBRD will have the same challenge. All the multilateral development bank have the same challenge. When I was talking to Enzo Laurenti, the Chief Procurement Officer of World Bank, his comment to me was, Nelson, look, I'm using my infrastructure procurement to deal with public health issue. We are shifting all our energy into health and safety or vaccination and all of that. And this is taking priority. So there is 2 years gap. How do we overcome that 2 years gap, Danny, and try and get back on the target? Thank you.
I think the first thing is we have to recognize that our member countries are facing an enormous challenge, and they're going to put their resources where the immediate priorities are, which is in dealing with the pandemic, strengthening health infrastructure, as was referred to earlier, vaccinations and so forth. And so our first responsibility as international institutions is to support our members with that immediate challenge, because until that can be dealt with, then the space and effort to invest in both the short and the long-term recoveries is not there. I think the second is to be thinking about how do we prioritize our investments in future, and how do we show that, for example, investment in climate resilient infrastructure is not only a good thing in itself, but also can play a major role in delivering an economic recovery. And so showing those benefits. But look, we also have to recognize that in many parts of the world, priorities will change a bit. I think not away from climate change, but towards it. But in other areas, healthcare infrastructure, technology infrastructure, those things are going to become more important. And in the end, as multilateral institutions, we have to also respond to what are the needs of our clients, our member countries and the private sector organizations that we work with. And at the same time, work with those clients to identify where are the investment opportunities that are consistent with the strategies that we've identified. We see in Asia enormous appetite for investment in low carbon infrastructure, for investment in digital infrastructure and healthcare infrastructure. So there will be plenty of opportunities. the first thing is to deal with the immediate crisis.
Danny, I'm not quite sure how to say thank you than to say massive thank you for your time. We did promise we release you at 12:45. It's spot on 12:45. Our industry is always pretty notorious to say not finishing on time and overcost. And I'm involved with a project at the moment that's cost a lot more money. So we want to be in good spirit. We're committed as a good engineer. We want to finish on time. And I want to say a massive thank you on behalf of the FIDIC board and the president for your time, your contribution, your leadership, the vision that you have too. We want to work with the AIIB. You've given us a good step in signing up an agreement on procurement, but there are other agenda that needs to do on what is happening on Belt and Co across the whole of the world. I know the interest of the bank is wider. I was delighted when you introduced me to the president of the bank 2 years ago, and it's been fantastic. So on behalf of the FIDIC president and the board, thank you very much for your time, and thanks for your contribution. We want to maintain that. Thanks a lot. Thank you. So on this
Thank
point,
you very much.
thank you. Thanks very much. Yeah. So at this point, I'm going to come back to, I think I'm going to put it across to Rowan. You work for United Nations, and I believe that, there is part of the UN, which is significantly playing across the globe. And the last few years I've seen challenges, but in light of the report finding, how do you envisage the environmental and the changes and the challenges that's come with it? So your report is coming through. How do you see the environmental challenges that goes with the industry as we see it? Rowan, the floor is yours.
Thanks very much, Nelson, and thank you to FIDIC for having me and for setting up the event. I think Graham already covered the basics of the situation really well. We already had a major challenge to develop the infrastructure we need to meet the SDGs by 2030. And now, of course, the situation has been greatly complicated by COVID and the pandemic. I think on the positive side, infrastructure investments are a big part of many countries' recovery strategies. And so this provides opportunities to help address this issue of urgency and close some of the infrastructure gaps. However, from our perspective, and I'm with the United Nations Environment Program, so we're particularly focused on this, the sustainability side of things. So for us, the challenge is really to ensure that sustainability doesn't get glossed over in the rush for this economic stimulus and a quick recovery. We've seen in the report how quickly and drastically the global perceptions of risks have changed from a primarily environmental focus to an economic one. I think, but we need to remember that these economic risks are relatively short-term, whereas the risks to the natural environment are long-term and existential risks that themselves include long-term economic risks on a scale that's as great as or greater than those of the pandemic. And so I think, we've seen governments placing a lot of emphasis on green recoveries, at least at the high level and the rhetorical level, which is great. But so far, actually, the majority of planned infrastructure investments as part of the recovery packages are actually reinforcing or directly supporting high carbon industries and forms of agriculture that are having hugely negative impacts on biodiversity. So this is the big challenge as we see it.
Thank you very much, Rowan. The next question I was going to put across to you is that I'm really pleased that you are working with us. And I do believe that you have a report coming through. The question from us, our point of view, and I've got Natalie, who is on our sustainability development group, and Robert later, in which we talk about what we have seen and what Bill has been emphasizing. How can we work better with you as the UN environment in terms of making sure there is a connectivity? Because as Bill would say, our job, what we are trying to do is to provide sustainability. The challenge for us is how do we get it across? And if UN is going to drive the SDG agenda and you are focusing on environmental, how can the like of FIDIC work closer with you to deliver the agenda? So Rowan, the floor is yours.
Thanks. Yeah, there's sort of two main sides to it. This transformative shift that we need in how we plan and deliver infrastructure, on the one side, needs sort of broad-based, high-level political support, but at the other end, it also needs the technical expertise and the innovation. We can't keep doing things the same way we have been, and so policymakers and planners need to think outside the box about how they can meet service needs, but then they also need the technical expertise to inform that thinking and help translate it into results on the ground and at the project level. And so, as you mentioned, it's next week on February 24th, we're releasing our international good practice principles for sustainable infrastructure. And they aim to address sort of one side of that of the issue by providing public sector decision makers with an approach for integrating sustainability throughout the infrastructure lifecycle, and with a focus on that sort of enabling policy and regulatory environment and interventions upstream of the project level. So, for example, during strategic planning phases. And so by doing this, we think, this can result in a more efficient and a more effective allocation of resources to infrastructure projects that are able to better balance the trade-offs between the social, environmental, and economic outcomes from infrastructure development. And so to think about it just from the project lens, ultimately, we're talking about, our report is aimed at trying to help governments think about it differently so that better projects are coming down the pipeline. And I think this complements really well what the side of things that FIDIC and some of the other organizations represented on the panel are working on, which are a bit further downstream in the life cycle, more on the project end of things. And so there's a natural complementarity, and there's a lot to be gained from working together to bring our various constituencies to the same table to talk about some of these issues. And I think in terms of the reports, this FIDIC report really sets this scene perfectly by providing a really compelling framing of the scope and the urgency of the challenge. And then I think the forthcoming reports in the State of the World series will also provide a nice complement by sort of taking it up a little bit further down the line and looking at some more of those technical details. So I think there's a lot of natural complementarities there.
Well, thank you very much, Rowan. I mean, that's very
Nelson?
important. Yes, okay.
Nelson, could I just quickly piggyback with Rowan, because he touched on something that is very, very high on my agenda as well, and that's the concept of that getting the right project identified early through strategic planning or big picture focus. A lot of the time, I think a lot of our partners may not realize that during that particular phase is often when the best engineering is done, selecting the right project in the right way. And in terms of cost reduction, the cost of doing that kind of thing is minuscule compared to the life cycle costs of the entire facility. So that was sort of music to my ears, Rowan, what you were saying. I had to jump in without being silent. So back to you, Nelson.
Bill. I can never silence the president. The president is always in charge. You only need to give me the instruction. Bill, you get the floor all the time. Natalie, I'm going to pounce on you in a very nice way. You're vice chair of the FIDIC Sustainability Development Committee, and you've been outstanding in your voice. I know Tracy's not here, but Tracy's got the two deputy, both yourself and Robert, so I'm going to come to Robert in a bit. Big number. What does this mean for sustainability? Do you think the client just wants to talk about delivery rather than sustainability? Because the point that Bill is talking about is that choosing the right project at the front end is very important. And we have a job to make sure we educate the client to understand the sustainability, because sometimes they just simply talk about it. We want it and it becomes an abstract. But when it comes to application, and as Mark talked about later on, they're really focusing on delivery. So what does this big challenge mean for sustainability in a big way from our perspective as a consulting engineer and solution provider and a trusted advisor? And how do we change the mindset of the client from delivery focus into what I call the whole life and true sustainability issue? Big question for you, Natalie.
Thanks, Nelson. And look, just like to say that it's been fantastic and really exciting to be part of the State of the World report, this one in particular, but also through the Sustainable Development Committee, will obviously be involved in the series. So thank you very much for the opportunity for that. Look, and as Graham, I guess, said, $7 trillion worth of infrastructure per year, it is a massive number. But obviously it's a massive opportunity to really shift the dial on sustainability too. So, as engineers and asset owners, as you say, we really need to think about that legacy that we want to leave from this sort of investment. We don't want to place a burden on future generations from either that sustainability lens or also from that economic lens. But I do think it is a real challenge to move into that front end stuff and make those decisions early enough. In fact, Bill and Rowan's comments were music to my ears too. My background's much more in that planning space than it is in the delivery space in some ways. And that opportunity to really influence the cost and influence the outcomes at that end is, I think, really, really important. And I guess of the three pieces of the puzzle that we've sort of talked about tonight, the infrastructure deficit, COVID and the SDGs, the COVID aspect and the stimulus funding, I think, is probably the biggest risk there, because there's a huge risk there, obviously, to spend money and spend it quickly and to get projects out the door. So, there could be something that sits in a strategic plan and it's an item of infrastructure. And so there's a desire to just push that through to delivery. And sure, you can make some sustainable choices along the way. You can, get more sustainable materials. You can focus on social procurement. There's all sorts of things you can do to make that project more sustainable. But when you consider it in a really holistic solution or in a really holistic way, is there a different solution? Is there green infrastructure, nature-based solutions? Perhaps that piece of infrastructure isn't actually required as it was initially envisaged. And we really need to take the time to actually invest in that investigation and really trying to drive that early development of solutions. And I guess you kind of, in my head, it's a little bit different with an infrastructure solution versus a project. So get that solution right and get that right up front so we can really drive that sustainability agenda.
Thanks very much, Natalie. The next question I was going to put across to you, which is quite interesting because it's flow from that. I think what you're saying, if I get it right, is that we have a responsibility as an industry to make sure we advise the client on the most sustainable solution and genuinely that look at it from whole life cost. The question for us is really the current trend continue to be spent on maintenance, on investment. And the question for me, from your point of view, how do we change that balance? Now, before you answer that, I have a phrase that I used to toy around with when I was a practitioner, and I call it 150 and 500, or 150 or 250, and I'll come back to that. The one is the design concept cost that he actually used to develop the whole process. And the 50 may be the capital cost of delivering it. And depending on the scale of the project, the 250 is the whole life cost of doing that. Most of the time, the client is pushing the one to become 0.75, which is reducing the cost of doing the design and the conceptual planning and everything. And what happened when you do that is the 50 become 70 or 80 because they keep changing the construction in that. So the outcome become more. And because they don't get it right in that one, which perhaps should have been 1.25, then the 250 becomes 700 in future because the whole life cost and the maintenance is completely unplanned. So the question, how do we shift the mindset from there?
Yeah, it is a real challenge, isn't it, to try and make sure that we are taking that whole of life cost. I guess the maintenance investment ratio that Graham talked about initially is quite an interesting one when you kind of dig into it and have a bit of a think about it. Obviously, we're dealing with maintenance from a lot of infrastructure that was built by previous generations. And perhaps that was in an era of cheapest price, and that's cheapest price at the back end, and certainly cheapest price at the front end to try. And so therefore the opportunity to really drive those solutions is a whole lot more challenging. I think in different parts of the industry we're seeing in more recent years and for quite some time, the UK water industry, for example, has talked a lot about TOTEX costs and whole of life costs, now moving into evaluating projects more on the basis of their carbon contribution and all those sorts of things. So there are some leading organisations, leading industries that that we can draw on. And I think as engineers, it's our role to really try and encourage our clients to take that step forward. It can be hard when you're just responding to a brief, obviously, but that's the role of us as trusted advisors, isn't it? Making sure that our clients can value our opinion, and we've got that opportunity to talk to them right up front when it is just a concept, and use our knowledge and the information that we can share through organisations such as FIDIC to talk about the importance of getting that cost category right. So your numbers there, Nelson, sound fantastic. I've drawn graphs that have got opportunity to influence costs and the cost of actually a project. I'm sure a lot of people on the call have seen and heard of those things before. So absolutely, we've got to get as far back upstream as we possibly can to really influence our clients to make sure they're making whole of life choices and sustainable solutions to take things forward.
Thanks very much, Natalie. I'm going to give you some breathing space, and I'm coming to Robert. I'm sure you'll be ready. And so we have the big challenge. We're not going to solve it in 1, not in 2, not in 3 years. There is the issue of the SDG, which is the responsibility of Sustainable Development Committee. But we also heard the issue about COP. It's COP26 coming up, or whatever it is. There's the Paris Agreement. Where can we make an impact, Rob? How do we get involved at our level and make a significant impact? Rob, what's your view on that subject?
Thank you very much, Nelson. May I say it's a great pleasure to be with everyone today talking about this, and appreciate the opportunity. So I think, as you say, Nelson, there's a huge amount of expectation building around COP26, the climate negotiations happening in Glasgow at the back end of this year. And of course, it's a big one. It's 5 years since Paris. So that's an opportunity for all the nations to come together and ratchet up their nationally determined contributions, their effort to get emissions down. And I think there's a slight danger of us getting hung up on just that milestone. No doubt it's going to be a pivot moment. I'm very excited about it because obviously we've got this huge commitment just made by China, 2060 net zero. We never saw that coming. That's big. We've seen the change of administration in the United States, which is going to shift the landscape on this and drive greater ambition. So I think it is a huge pivot point, and we're going to see massive outcomes from that meeting of minds, because I think everyone wants to show that they're doing the right thing, and they've got a good mechanism to do that, which was established at Paris. But I think what we've got to do is, as I say, not get too hung up on that particular point in time. It will be a threshold, but what are we going to do before then? What do we focus on between now and November of this year? That's quite a few months where we can already make some significant changes. What do we do after Paris? What are we doing this time in 2022, 2024, 2025? What have we done by 2030? So I think the key thing for me, Nelson, is that we chunk this up into bite-sized chunks. The old adage, how do you eat an elephant? Bite by bite. You can't bite it off all at once and do 2050 all in one go. It's going to take time, and we need to give ourselves time to work out what is the best thing that we can do now, in the next few months, in the next year, in the next 2 years, in the next 5 years, that will give us the strongest foundation for hitting net zero by 2050, or if you're more ambitious, 2030 or 2040. So I think that's the key thing I want to give people to consider. And I think at FIDIC, in the Sustainable Development Committee, we've been thinking about this very carefully over the last few months. We've sort of started working together with a new committee at the beginning of the academic year, if you like, back end of last summer. And we've come together now, we've formed a good quorum. And we're thinking about sort of 4 levels at which FIDIC can influence. And we start with the individual, the professional engineer, the individual professional engineer. What can he or she do to address the climate challenge in their professional work on a day-to-day basis? How can they influence their clients, their boss, the people that work for them? And that's actually an intrinsic position within the whole FIDIC family, the individual professional engineer. And then, of course, we've got the engineering companies themselves. And I work for a large multidisciplinary engineering consultancy. Now, you wouldn't believe how competitive it's getting, Nelson, within this field to be doing the best that you can to address the climate challenge. Every other week, a new goal or commitment comes out from one of our peers. And indeed, we're working hard at AECOM, with my AECOM hat on, to address the climate challenge. And then I think we've got the member associations all around the world, as you said, over 100 countries represented. Each one of them is doing important things to address the climate change, address the climate emergency, and really put in place strong decarbonisation and net zero measures. And then FIDIC itself, we have to be leading from the front. And I think over the next few months, we'll work on a charter or a document that we can take to COP, which actually says how we are going to lead from the front. And we'll take on board some of those things I've just mentioned. And I just want to finish because it links to some of the points that Danny and others have made. This point about data and using that to really integrate well with the natural environment, natural systems. So how can we integrate carbon sinks in the sources that we have? So when we build a design infrastructure, we tend to be locking in a lot of carbon, be it concrete, steel, copper wires, timber, what have you. So that's a significant carbon source. How do we integrate the carbon sink into the same projects that we designed so that you end up with a balance, hopefully net zero carbon? I think that's one of the things that we as engineers really need to get our head around. And the digital revolution that we're going through and the data that we're having can really help us on that journey.
Thank you very much, Robert. I think I can see Bill shaking his head as he goes along to say this man is saying the right thing. I mean, I'm really impressed because all the point you seem to take, Bill was writing on, and that tells me I'm going in the right direction. But put it this way, Robert. I mean, yes, it's good to say don't look just into the milestone of November, December, and we do another COP26, and then we pack it. No, I think what you're saying is we're on a journey. Between now and COP26, and what we do after COP26. And COP26 is just a milestone of a point, a pillar where people come together to sign up to what the challenge would be. The real challenge is about delivering those commitments and how do we do that? And we do that through some of the measures that you've raised. That's very interesting. Second question I have for you, really, I think I'm going to read it out. It's a long one, which is FIDIC suggests that a mechanism to redistribute investment in the capital envelope towards sustainable projects is needed. And Danny from his, AIB is demonstrating the shift. What can a consultancy, an engineering company do about their own operation? Now, let me just, before you go into that, and I'll let you into my confession. Okay, somebody said earlier on, and I'm not quite sure whether it's Natalie or whether it's Adam, when I come to Adam, saying there is an opportunity. We shouldn't see it as all negative, because when you look through the statistic from what Graham is saying in the early point, he said, you go to some parts of the world, the cloud is clear. You see the birds singing. You see less people traveling. You ask the question, do you need all the airport? You see all the aircraft sitting there because the technology is a game changer. And the question is, in our own space, what can we actually do to impact the change? Is it about telling all the executive that your traveling time is going to be reduced because Zoom is here? Is it your carbon footprint that you need to set your own target, that you monitor rigorously, and you declare that in your annual report of improvement done? So what can we do as a practitioner to actually give the commitment to that? Everything add on to the carbon reduction. What can we do as a practitioner?
Well, all those things you've said, Nelson, are really, really important. And as I said, you wouldn't believe how competitive it's getting for everyone to be doing the right thing in our industry. And you've got some really fantastic movements as well that are sort of spurring people on, Pledge to Net Zero, Race to Zero, all these sorts of things. So the first thing is you've got to follow the carbon hierarchy, haven't you? I think if you're going to be tackling climate, so you've got to, decarbonize, get your own emissions down, then switch to renewable energy sources. We've heard a lot about how we need to be switching away from fossil fuels in this talk. And then for the last bit, it's investing in nature-based solutions. What can we do to neutralize those residual emissions that we can't get rid of? I'm terribly optimistic about this. If you look at some of the recent figures, Nelson, over 1,000 companies have committed to setting Paris-aligned science-based targets in recent times, with a market cap of nearly 16 trillion. Now imagine what that figure will be like if it gets up to 10,000 companies that have signed up to science-based targets. And what if half of those were infrastructure engineering consultancy companies? That would be a huge shift in itself. So that's what makes me really optimistic. The other thing, this session is all about finance and the money flows. You wouldn't believe the amount of interest there is from investors, from the pension community, the large investor groups, in looking at what they call, their language is ESG, environment, social governance. That's how they break up the sort of complex sustainability agenda into sort of manageable chunks. And the questions are coming thick and fast about how every large quoted company in our realm is looking at their scope 1 emissions, their scope 2 emissions, their scope 3. And I think the biggest one where we can make an influence with the larger engineering consultancy companies is we've got the resources and the knowledge and the know-how to bring the whole value chain along with us. So our scope 3 emissions at AECOM, for example, are the biggest part of our carbon footprint, our environmental footprint. So we're going to be working hand in glove with our whole supply chain over the coming months to understand what our total emissions are and how can we work together to bring that down. And I think that's because that's being led by the infrastructure sector, we're going to have a huge impact because we'll have the full sort of might and intellectual capacity of our engineers, of our environmental scientists. So some very bright people will be tackling this. And I think that will yield huge dividends.
Okay, thanks very much, Robert. I'm going to come back to Mark now. There's a lot of questions coming through the floor, and I think some of the response we're providing is addressing it. There's quite a lot on transparency. I'm going to come into that by, my good friend, Hamish. But let me come back to Mark. Mark, you touch on the issue about the cost of doing nothing, something like that in your report. I think the cost of doing nothing. Do you believe this cost is actually realized by the wider public enough to make concerted political action by doing that? So what is your take on that subject of cost of doing nothing? What does it mean really to investors, to supply chain, to the participant in investment in infrastructure? What's the cost of doing nothing?
So I think the point is if, as we all know, I mean, we're talking about projects, and I'm probably the narrowest person on the panel in the sense that I'm purely addressing private capital rather than the wider engineering remit. But I think what my point overall is that if you've got a project that you think can increase the economic value, or indeed add as we just discussed ESG credentials to a project, then the question is if you do nothing, then you don't get the economic benefit, and therefore it's actually a loss. But of course, it's because we don't really look, I mean, in monetary terms, in financial terms, we don't really look at the second tier, if you like, what the World Bank would call land value capture, or what you look at in terms of the economic benefit of that piece of infrastructure is not calculated into its cost. And the return profile that should have. And I go back to the education that I was talking about before. I think this is terribly important, and in particular what Robert was talking about as well, is it comes down to you need to educate the money more. You've got the skills at your end, and whether we talk about natural capital as one end, ESG, Terra Carta, if we want to talk about the Prince of Wales' recent initiative, or you talk about any of the other, and indeed greenwashing, because that's just as much a challenge because it confuses the hell out of everybody when you're actually looking at the marketplace. So I think the point about what's the cost of doing nothing? Well, you'll find out when you do it, because you won't, if you don't realize the piece of infrastructure that you need, you won't get anything done. So that's not going to really help you. So I think there has to be some bold decision making. Maybe it's policy, but I think also as we've been talking about, across the panel chatting, is I think if we get the right price competition, we can get to Bill's earlier statement. If you're worried about cost, you can get price tension using the financial markets into this. They're used to pricing risk, but they need the data to be able to price the risk. They need to understand, they need the education. And you as an engineering group, as the people that know, as I said before, the people with the expertise that don't have the money are the people that need to educate that world better about what risks they can take. I remember having a conversation, I suppose I'm name dropping here, with Sir John Armitt. And he said to me, well, people underestimate the risk of maintenance and overestimate the risk of construction. Well, as engineers, that's probably a fairly obvious statement. As a pure money and data man, I've got no idea what you're talking about. So, I do better now, but do you know what I mean? It's really important to address those aspects in order to, and I say, talking to the guys at Manchester University, for example, how do you address that value that a piece of infrastructure creates, whether that's 20% GDP growth for education, or whether it's better healthcare and the cost of the general economy not being a thing. And I've noticed we've had a lot of questions as well on
Well, I was going to come to the question on the floor. One that is coming through, if I can, I'm going to put question to each and one of you at a time. I don't want two people answering the same question, so we can cover as much as we can. So the first one is to Natalie. This is from a guy called Gavin Pearson. It's a name that sounds familiar. I haven't chosen, but it just happened to be one Andy put to me. He said, does everything said so far tend to suggest we should focus on retrofit, not new build? For an economic stimulus, retrofit can generate actively faster than new build and can play a part in bringing down rising operation costs. What's your take, Natalie, on that?
I mean, I think with anything, we've got to take that holistic view. What is the right solution for whatever the particular problem is? So we've got to start by understanding what's the problem. That's the very first thing, and really define what is the problem that we're trying to solve, and then identify the right solution for that. Now, sure, retrofitting might be it, renewal of an asset might be better than constructing a new one. Those are all the things that absolutely need to be on the table when we're looking at coming up with what the best infrastructure solution is. Not just with our blinkers on saying we need to build something new. We should be looking at no infrastructure solutions. That's obviously really important too. There's not building something can still be a way to solve the initial need. So I think it's really important to think very holistically, but to try and understand what is the problem we're trying to solve, and then make sure that we've got the right solution that addresses that in a sustainable manner.
Okay, thanks very much, Natalie. For each question, there's another question from Hamish Goldiscott, a double barrel name, means double trouble. Several speakers have referred to the importance of transparency and good infrastructure governance achieving value for money. And some have stressed the importance of compliance with anti-corruption policies. But despite decades of such policies being in place, a major IMF report recently concluded that countries waste an average of about 1/3 of their infrastructure spending due to inefficiency. Surely, compliance is not enough, and as much needs to be done to address this shortfall in efficiency. Now, who should I put that to? I know Bill. This would be ideal for Bill, but I'm not getting Bill because I know Bill is going to do the closing round.
Well, I'll jump in anyways, just for a quick second. The estimated cost of money that is wasted every bloody year on lack of integrity would close this gap, some think almost totally. That's how important that issue is of corruption and wasted revenue. So once again, I followed up your agenda, Nelson.
No, Bill, it's always good for you to butt in. But I was going to ask Adam, the young one, because this is a sort of an history. I mean, I can go on my soapbox on this, but I wouldn't do that, in the sense that people talk about construction industry being corrupt, but the oil and gas industry is corrupt. The defense industry is even more corrupt, but I won't go there because, they're government to government. But, the question, the young ones, how can we tackle, FIDIC has got films, got all of that. How do we engender in the new generation to make sure we stop losing 1/3 to wastage and inefficiency through corruption and things like that? What do we think we should be doing, Adam?
I think it's been mentioned in this webinar already that education and transparency, educating the MIABs that are actually giving the finances, and then the public clients that are using those finances and distributing them. I think increasing as a SME, so a small medium engineering firm from Central Europe, I would think that putting in line, cooperating with these banks to making sure that their tender documents are, written in a way that is transparent and engages the actual professional that's going to execute the work, that he doesn't need to go through various, let's say, intermediaries to actually complete the work, and he can do the work himself. I think that would be a place to start.
Okay, thank you very much. Next one I'm going to put across, this is from Jeremy Mayhew. The decision made by client to save costs at the early stages of project can create huge costs in the long run, and is driven by short-termism, which is due to the profit reporting time scale of major company and the budget of government bodies, which is quite clear. This all works against quality, innovation, and decision making. What can be done to change this model? Can I bring? I think I'm going to bring Robert in. How do we change the mindset of the short-termism and look at the long-term issue? Whether you are advising government department, which talk about value for money, but truly that means the lowest bid, or you're talking about private sector. So you say, well, I don't need it. because I might not be in existence in a few years down the line. So I just need to do some. So how do we address that, Robert? Yeah.
I think the way of looking at it is to look at the legacy. I think it was Natalie that mentioned that word earlier, sustainable legacy. I think it's going to be a bit of a mantra for us in the infrastructure industry going forward, because we certainly can't be making decisions now that will simply result in more rapid need for sticking plaster sort of maintenance later on, because the right decision hasn't been taken about the infrastructure development in the first place. So I think there's a couple of things here that I want to bring in, and some of these concepts have been mentioned already. One is the capitals decision-making process. Many people now work, if you look at some of the more advanced water companies that Natalie mentioned, actually, take Yorkshire Water. They're very advanced in their thinking about the capital's decision-making process. That means bringing in the natural capital, the social capital, human capital, manufactured capital, and financial capital into the decision-making process, so that you're actually considering all those decisions as you decide which assets to invest in, when to invest in them, and how that will be responded to by the beneficiary communities and the wider stakeholder groups. And what do they think of those spending priorities? So you have to have that inclusive process. And I think the capitals framework is a really good one for demonstrating that, because it starts to bring into the investment mindset stuff that until 5 or 6 years ago wasn't being monetized at all. So those, what we would have called in old language, sort of externalities, the natural environment, people's jobs and how connected they are in the community and what they feel about the infrastructure that they've got to work with. These are now getting a more tangible feel in investment decision making. And I think that's leading to better investments. The other thing I think we need to think about for our sector is the transition around circular economy thinking. And that means moving from delivery of products, assets, to delivery of services that are maintained over time. And that gives you a better envelope for actually addressing the whole conundrum which this report talks about, which is the divergence between investment and maintenance. I think we need to bring that together, and there are lots of different ways in which we can do that. There are debt instruments, there are financial envelopes that we can use so that the end user, be that a transit authority or a water utility, they can benefit from a service approach, because they actually end up with buying the product at the same cost, ideally, if we can work the maths and the debt equity, the balance, and so on, so that they actually get the capital investment at not much or at the same parity as they would have gone for continuing the investment in the existing infrastructure. And that's particularly important where we're trying to wean ourselves off fossil fuels. So take an example of trying to invest in electric vehicle infrastructure projects, which a lot of the global transit authorities are doing right now. They're trying to get their fleets and their buses and their trains over to non-fossil fuel systems. But they don't want to be faced with a sort of $600 million investment ticket when they've got all that debt that they're already dealing with, plus COVID debt piling on top. So they want to see the infrastructure design engineers, third-party finance, and the construction or the technical developers to roll out the infrastructure working together and coming together and offering them an innovative package or solution that will allow them to get that done and won't won't be a massive hit on CapEx, but will be part of their OpEx. And that way you can also bring in the sort of circular economy thinking, which means that you're ending up getting a service rather than a product that then, it hasn't been thought about in terms of its next life or what happens when it breaks, that kind of thing.
Thanks very much, Robert. I'm going to bring Graham in, the guy who's been, involved with all this at the beginning. Graham, I'm not quite sure. I've read the report several times and I reviewed it. There's a question for Mohammed Adna bin Modern. I think the question goes, I'll read it out, and I think you are the right person to put this question, because if the answer is in the report, you should know where it is. He said, how much investment do you think will go into governance and transparency? This is still a major issue in many parts of the world. Imagine the percentage of the $1 trillion being set aside for development lost to corruption and leakages. I still feel that we are not investing enough in addressing this. Now, this goes back to the point that Hamish is saying, and Bill jumped in earlier and talked about that. So, does your report actually, touch on that? Is it something that you feel is for another day? Graham, where are you?
Okay, that's quite interesting, because if you take the numbers in the report and you look at the challenges it's presented, as in most research, it uses effectively publicly and available data. and investment and professional services numbers are reported on what the challenge is. Funny enough, when you go into most national statistics, there isn't a data set for random money spent on governance that doesn't exist. So if you like, the challenge in the report does not include such costs. So if you wanted to add such costs in, if we said it was 7 trillion, you could easily probably make it 10. And it just highlights the fact that these things are based on the data and the way they're collected at the best at the time, and it is the best information we have. But those inefficiencies are inherent within the data sets, and there isn't a data set for ineffective spending. I mean, if we could create one, I would probably be the happiest person in the world because I'd spend lots of time analyzing it. But at the moment, the challenge we face is based on data which does not contain such inefficiency effectively.
Thanks very much, Graham. I thought you were the most qualified person to put that through, but I have to be honest, one of the things that Bill is talking about is, yes, we got a big number. The question is, how do we reduce the big number? And if that big number needs to be reduced, part of that element is the corruption element. Let's assume your figure is right. Let's assume the projection is right. It's not 3, it's not 5, it's 7. And that 7 is inbuilt all the inheriting, of issue of lack of transparency and issue. The question is, how do we bring that figure down? And it may be re-engineering, it's about maintenance, but actually, how do we plug the leakages in the way we do procurement process? So this is part of things we need to look at and perhaps a subject for another day. So I'm mindful of the time. Barbara is always very good. She's told me I've got 2 minutes to wrap up. And so I'm going to do the usual stuff that I'm going to ask each and every one of you to give me a closing statement. And I will ask Bill after that, to give us a sum up, and I'll come and close out on that. So if I start with Natalie, ladies first. Natalie, what's your closing statement? Report is out, 3 recommendations, and all of them is in the public domain. Nobody's questioning it. And you've had Danny and everybody talking about it. What's your 1 sentence go away for us to think about? Natalie.
I guess $7 trillion infrastructure challenge opportunity to make things much more sustainable. But as we said, really critical that we get to have the involvement and look at that solution development side of things to make sure that we can identify the best solutions.
Okay, thanks very much. Rowan, what's your comment, takeaway?
Yeah, I'm gonna lean on what Robert and Natalie said as well, and that we, to address this massive challenge and take advantage of the opportunity, we need to start thinking about things in terms of solutions to service delivery and thinking innovatively about how we can do that, in a way that's low carbon, using less resources, and ultimately delivering more sustainable outcomes.
Okay, thanks very much. Mark?
I would say data, please, to drive education to people in financial markets. And yes, Robert was just commenting, if we can provide, and we're seeing this already on the exchange, demand from technology companies to deliver cookie cutter sites, where they're effectively taking the engineering, the design of sites, so they can be built once or engineered once and delivered many times, then I think that would help to reduce the company that as well. So those would be my.
Adam, Chair of the Future Leaders, what's your
I think that for especially small and medium engineering firms, it's a great time and a great opportunity ahead of us to tap into these $7 trillion. And I think we should invest in how we market, deliver our services, and be agile, because as Robert from Auricon said, that they're finding it tight. I think this is our opportunity to attack, to be there in 5 or 10 years. So let's do that.
Okay, thank you very much, Bill. Your comment, and I believe we have one more poll. One more poll. Is that coming through, Barbara? So can we just do the poll before we ask Bill to do? The last poll, 2030 is not far away. Has this webinar helped to realize the scale of the challenges? Yes or no? Time to vote. Time to vote. Thank you. Do we have the feedback from that? I suspect 98% yes. So Graham, I think you can assume that, chapter 1 of this report is now over, and now you can start to think about chapter 2, which Bill is going to task you on. Bill, the floor is yours. What's your reflection? You've seen it, you've discussed it. What's your reflection? Very quickly, 1 minute, 2 minutes.
Thank you. First of all, I'd like to thank all the panelists and you, Nelson, for an absolutely fantastic discussion, hitting on a lot of key elements to this huge challenge, which I think, as Adam said, creates a lot of opportunities as well. One of the closing thoughts that I would offer is engineers, I think we all know this, engineers and scientists and physicians and lawyers, any profession, they're really good at talking to each other, but they're not that good at communicating with other professions or other stakeholders. And as we all know, the kinds of challenges we're trying to deal with affect everyone. They affect everyone on the planet. I think the engineering profession is getting a lot better at communicating these kinds of needs and what the engineering community can do to help address the challenges. We've got a ways to go, but I think we're getting much better at it. And this particular webinar, I think, is proof in it. We've been talking about all sorts of elements of the challenge that maybe 15, 20, and maybe even 10 years ago, we wouldn't be talking about. So it's really encouraging to see the engineering community broadening the tent and talking to all stakeholders about these problems, because as one of the panelists mentions, engineers have the expertise, but not the money. And there's folks with money that don't have the expertise. Bringing these things together is part of the solution. We also mentioned that insidious problem of corruption with the numbers that are wasted in that particular element they're just huge, and we've got to all work together to end that. So thank you very much, everyone. We've conducted a lot of webinars and seminars over the last 12 months. This one is right on the top. So thanks a lot.
Well, thank you very much, Bill, for that closing remark. I don't have any more to say than to actually say a massive thank you. I'll probably say thank you to our partner, UN Environmental Program and SIP, who we are collaborating with, and we are working with them. And as Rowan said, there's opportunity for us to bring the transformation side on the policy and the technology together. I also want to thank all our members, wherever you are around the world, who's been involved, and remind you, the FIDIC committee webinar will continue. The next one is on the 23rd, which is next week. We have the next, State of the World report, which we hope we will miss the target of 1st of April, and that's in the pipeline. Then we have other coming through as well on the COVID webinar on the 2nd of March. So please stay with us and join us. I just want to round up by saying we were privileged to have the like of Danny Alexander, all the way from Asia in China to support. Mark Warren from ERX, this is not his first time, but I think we're educating him. He needs to educate us about how do we bring the money to the engineering, but I think we are also educating, because he confirmed that. He confirmed he's learning more about our industry. But actually, if we can speak to ourselves and speak to others as well, so that we understand each other and we get the language, that'd be very good. So Robert, thank you very much for your support. It's good to have the big, complex, global perspective on the subject. I understand, the competition is tight. Everybody's in business to survive, but at the same time, what we need to do with the committee is very important. You said it quite clearly, the COP26 is a landmark, but what do we do leading? What do we do at? And what do we do post? Those are the things that really matter to move things forward. So I think that is very, very important. We need to have that at the back of our mind. Adam, you said this is a big opportunity for us. We should rise to the challenge and we should deliver what we need to deliver. And for the young one, they should see the industry as bright and prosper, but we need to deliver in a different way. The next report on infrastructure will be looking at how does the engineering solution come together. Those points that Bill talked about, which is, yes, it's 7 trillion, but can we deliver it for 6 trillion? Can we do reverse engineering? Can we be innovative? Can we be creative? Can we look at it in a holistic manner? So again, thank you very much, Adam, for your input. Natalie, thank you very much for your inputs in terms of looking at the system and the process, and your perspective is really highly appreciated. I want to say thank you to everybody behind the scene who is been supporting us internally. There is no one single person that drives FIDIC. It's a team effort from the board supporting us from what we do in the New Challenge News corporate plan, to the individual who is driving a particular program. Behind that program, there are other people behind the scene, either in terms of communication, planning, event, and production, and making sure the quality of document is really up to standard. We are trying to be at the table. And I think Bill is challenging us. We need to be at the table. We cannot continue to talk to each other. We have to talk to other people, and we have to educate other people, and they need to educate us, so that at least we can be at the table and we make the right impact. On that note, I'm going to say massive thank you to everybody, all those who participated wherever you are, and I hope you are keeping safe. The next program is down in the pipeline, so stick with FIDIC, and we'll have opportunity to share with you in the near future. Thank you very much where you are, and keep safe. God bless. Thank you. Bye.